You're sitting on the edge of a mattress that isn't yours, it came with the apartment. The last tenant didn't want to pay for a dump run, and your phone is 3 inches from your face, refreshing a banking app that keeps saying the same number back at you. $1,142.17. Rent's due in 6 days. Somewhere in the scroll before this, you watched a guy your age standing in front of a rented G-Wagon telling you real estate is how normal people build generational wealth, and something in your chest tightens, but not from inspiration. From arithmetic. $1,142.17 doesn't buy a garage. It barely buys groceries and a lift to work for the rest of the month. Here's the thing, nobody tells you standing at that number you're not failing at real estate. You just think it's 1 door when it's actually 7. Picture it like a game you've never played before, one where the tutorial level and the final boss look nothing alike, use none of the same weapons, and reward none of the same instincts. Level 1 is a 3.5% down payment and a spare bedroom. Level 7 is a family office wiring 9 figures into an entity with your name on the operating agreement. Almost everyone who quits at level 1 because they looked at level 7, the portfolio worth more than a small city's tax base, and assumed that was the entry price. It isn't. It's the score after 7 completely different games played back to back for years. That's the mistake this video exists to correct. Not how do I get rich in real estate. That question is too big to answer and too vague to act on. The real question is smaller and far more useful. What does the very next level actually require, and is it the same tool you're already holding or a different one entirely? Because that's the part almost nobody says out loud. What gets you from $0 to $10,000 will not get you from $10,000 to $100,000. What gets you to $100,000 will actively hurt you at $1 million. The financing, the mechanics, the psychology, all of it turns over at every threshold, like gear you have to trade in at the door before the next level lets you through. Most people don't quit because real estate doesn't work. They quit because they kept swinging the level 1 tool at a level 4 problem and it stopped connecting. So this is the walkthrough, $0 in a checking account to a $500 million holding company, level by level, mechanism by mechanism, what each one actually is, what it actually costs, and what it actually breaks in the people who try to skip it. You start tonight, on the edge of that mattress, with $1,142.17 and a decision most people never make. That the ladder is real, it's climbable, and the first rung has nothing to do with money at all. The first rung isn't a purchase, it's a reclassification. You stop asking, how do I buy a house, and start asking, how do I buy a building that pays me to live in it? This is where you actually stand. No capital worth mentioning, no track record, and a chorus of people, your uncle, your coworker, the comment section telling you real estate is for people who already have money. They're describing level 5. You're not there yet, and you don't need to be because level 1 was never built for people with money. It was built for people with a job and a pulse. The move is called house hacking, and the mechanism that makes it possible is an owner-occupant loan FHA-type financing that lets you put down as little as 3.5%. On a $280,000 duplex, that's roughly $9,800 plus closing costs, not the $56,000 a conventional 20% down investment loan would demand. The catch, and it's not really a catch, is that you have to live in one of the units. Buy a duplex, triplex, or fourplex, move into one unit yourself, and rent out the rest. The part that actually unlocks the math is this: when the loan officer calculates whether your income can support the mortgage, they don't ignore the rent the other units are about to generate. Lenders can credit roughly 75% of that projected rental income toward your qualifying income. On a duplex where the second unit rents for $1,600 a month, that's an extra $1,200 a month the underwriter treats as if it already landed in your paycheck. That's the entire trick. That's why an ordinary income, the kind that could never qualify for a straight investment property loan on the same building, can qualify for this one. The building cosigns for itself. You move in. You start collecting rent from a tenant who is functionally your first employee, except they're paying you instead of the other way around. Some months, the numbers barely work. You'll fix a water heater at 11 p.m. You'll learn what a security deposit statute actually says because a tenant will ask you, and you won't know, and you'll have to find out. None of that is the point yet. The return isn't the point at level 1. You're not optimizing cash flow, you're not comparing cap rates, you're not thinking about scale. You're doing something much smaller and much more important. You're becoming a landlord for the first time with training wheels the government basically installed for you. You stop being the person whose rent check builds someone else's equity every month, and you become the person whose mortgage other people's rent checks are quietly paying down. That shift, not the dollar amount, is the actual unlock. Everything after this level is just repeating that shift at larger and larger scale. Level 2 starts with a strange problem. You have equity now, and tenants, and a building that actually cash flows a little, but you don't have new cash. Whatever you had went into that 3.5% down payment and the inspection and the emergency fund you told yourself you'd never touch. This level isn't about saving your way to the next property. Saving $9,800 a second time on a normal income could take years. This level is about manufacturing capital out of a building instead. The method has a name real estate people say so often it stops sounding like an acronym. BRRRR. BRRRR. Buy, rehab, rent, refinance, repeat. You buy something ugly below market, needing work, the kind of listing that scares off buyers who need a place to live tomorrow. You rehab it. New flooring, a kitchen that doesn't look like 1994, maybe a bathroom added if the layout allows it. Every dollar of that rehab is aimed at one number. The after repair value, the appraisal the property will earn once the work is done, not what it was worth when you found it. You rent it, get real tenants in, real leases signed, income stabilized, so the building has a track record a bank can underwrite. Then you refinance, not a sale, a cash out refinance, against the new higher appraised value, pulling cash back out of the equity you just created with a crew and a few months of your weekends. Here's the trick that makes the whole cycle work. If the rehab was priced right and the ARV comes in where you projected, the refinance can return most or all of the capital you originally put in. Not the profit, the actual principal. Which means the same money that bought and fixed property 1 can, in theory, buy and fix property 2. And then 3, you're not saving a second down payment. You're reusing the first one over and over, each time leaving a tenant-occupied, cash-flowing property behind. This is the level where a house becomes a portfolio. You go from owning 1 duplex to owning 3 or 4 smaller properties in 18 months, sometimes less, and you start doing something you never did before. You check occupancy across properties, not just one address. Say the risk plainly, because this level eats people who won't. BRRRR doesn't fail because the concept is broken. It fails because the rehab runs thousands over budget on a contingency fund that was never big enough, or because a unit sits vacant for 4 months while the mortgage doesn't pause to wait for a tenant. The math only works when the rehab estimate is honest and the vacancy assumption is conservative. Everyone who's been burned by BRRRR was burned by one of those 2 numbers, not by the letters themselves. By now the properties are multiplying, and so is something less visible: risk. Every building you own in your own name is a lawsuit away from every other building you own in your own name. A tenant slips on ice at property 2, and the judgment doesn't stop at property 2. It can reach property 1, your car, your savings, whatever a court decides to attach. At level 1, that risk was theoretical. At 4 or 5 properties, it's a liability sitting in plain sight, and this is the level where you finally deal with it. You form an entity, an LLC, at minimum, sometimes a single LLC holding everything, more often, once you're paying attention, a holding company structure with an individual LLC under it for each property, so a claim against one building can't reach out and touch the others. This isn't a tax trick, it's a wall, and it does something else at the same time. It makes you look to a lender less like a person with a hobby and more like an operator with a company. That matters because the financing tool changes here too. FHA loans are done, those were for an owner-occupant, and you haven't occupied anything in a while. Single-family BRRRR starts to feel small relative to where you're trying to go. So you move into larger multifamily, 10 to 20 plus units, financed with something called a DSCR loan, debt service coverage ratio financing, underwritten almost entirely off what the property itself earns, not your W-2 or your tax returns. Lenders want that ratio around 1.20 to 1.25, meaning the property's rental income needs to run 20 to 25% higher than the debt payments it has to cover, and they'll typically want about 20% down and a credit score in the high 600s or better. Your personal income stops being the ceiling. The building's income becomes the ceiling instead, and a good building can qualify for financing your paycheck never could. Something else breaks at this level, and it's not financial. It's cognitive. At 4 properties, you could hold every unit, every tenant, every lease renewal date in your head. At 15, you can't. You stop being able to personally verify anything, and the businesses that survive this level are the ones that replace memory with systems, property management software, a maintenance log, a real accounting setup instead of a shoebox of receipts before the memory runs out, not after it already has. That's the change that actually matters at level 3, underneath the LLC paperwork and the DSCR math. You stop being a landlord who happens to own several houses, and you become the owner of a company whose product is real estate. Small distinction on paper. Everything downstream depends on it. Somewhere past $1 million in assets, the bottleneck stops being money. You can find deals, you can get financing. What you cannot do anymore is answer every maintenance call yourself, because there are, at this size, several maintenance calls happening at once, in different buildings, some of them at 2 a.m., and you are one person. The obvious fix is to hand it off. Outside property management companies exist for exactly this, and they typically charge somewhere around 8 to 12% of collected rent, sometimes more on smaller or higher maintenance buildings, sometimes closer to 6% in expensive markets where rents are large enough that the percentage still adds up to real money, plus a leasing or placement fee that often runs 50 to 100% of 1 month's rent every time a unit turns over. On a portfolio collecting $180,000 a month in rent, 10% is $18,000, leaving the business every single month, forever, for someone else to answer phones you could theoretically answer yourself. That fee is the whole argument for level 4. At enough scale that 10% isn't a cost you accept to save your sanity, it's a business you're paying someone else to run instead of running it yourself. So you build it in-house. You hire a property manager, then a maintenance coordinator, then a leasing agent, and the management function stops being overhead attached to your real estate and becomes its own arm of the holding company, with its own revenue line, its own margin, sometimes eventually managing properties for other owners too, ones who have no idea you also own real estate of your own. This is the level where the holding company stops being a pile of assets sitting quietly and starts being an operating business with a headcount. There are people who report to you who have never met a tenant of yours in person because their job is payroll or leasing software or dispatching a plumber. There's a brand now, a name on the maintenance vans, something another investor could eventually plug their own capital into, because it's no longer just your properties, it's an operation with processes that work whether or not you personally show up. The psychological shift matches the operational one exactly. At level 3, you are still thinking property by property. What's the next building? What's the next DSCR loan going to look like? At level 4, you catch yourself thinking about something else entirely. Who's the next hire? Not the next asset, the next person. That's usually the clearest sign you've actually leveled up, more reliable than any number on a balance sheet. You've stopped being able to answer what do you do all day with a list of properties and started answering it with a list of people. Push past $10 million and you hit a wall that has nothing to do with skill. It's arithmetic. Your own capital is finite. Your own borrowing capacity, even with a track record and a DSCR portfolio behind you, is finite too. Lenders cap how much debt they'll extend to a single operator, however good that operator's numbers look. You can be excellent at every level up to this point and still be structurally unable to buy the next deal, because the deal is $40 million and you don't have $8 million sitting around for a down payment, and neither does your balance sheet's borrowing room. The only way through is money that isn't yours. This is where syndication enters, and it's a real change in what your job even is. You become the general partner, the GP, the sponsor. You still find the deal, still arrange the financing, still run the operation day to day. But the equity, the actual capital that closes the purchase, comes mostly from limited partners, LPs, investors who put money in and expect you to do everything else. The GP gets paid 3 ways, and it's worth knowing precisely, because this is the mechanism most people get wrong when they imagine it: an acquisition or raise fee, typically 1 to 5% of the purchase price or the amount raised, paid at closing; an ongoing asset management fee, usually 1 to 2% of collected rents, paid for as long as you operate the deal, and a share of the profits on the back end, but only after the LPs receive a preferred return first. You get paid last on the profit and first on the fees. That ordering isn't an accident. It's what makes LPs willing to hand a stranger $8 million in the first place. This is the real unlock of everything you've built so far, and it's worth saying plainly: your income stops being tied to how much of your own money you have and starts being tied to how much of other people's money you can responsibly manage. That single sentence is the difference between a landlord and a fund manager, and almost nobody explains it that clearly, because it sounds like it should be harder to say out loud than it is. But it comes with a new product to sell, and it isn't the real estate anymore. It's trust. An LP is not buying a duplex. They're buying you, your track record, your underwriting discipline, whether you answer the phone when a deal goes sideways. Every LP check you raise at this level is a bet on your character, priced in dollars, and the first time you lose a deal's money, that trust doesn't come back at the same price it left at. By $50 million, deals aren't scarce anymore, and neither are LPs willing to write checks. You've proven the model enough times that both sides of the equation are available. What's scarce now is efficiency, how fast you can turn capital over, and how much of every dollar of gain actually survives contact with the IRS. This is where the 1031 exchange stops being a line item your accountant mentions once a year and becomes a core piece of how the company operates. Section 1031 lets you sell an investment property and defer the capital gains tax and the depreciation recapture tax, both of them, not just one, by rolling the full proceeds into a like-kind replacement property instead of cashing out. The deadlines are unforgiving. 45 days from the sale to formally identify a replacement property, 180 days total to close on it. Miss either window and the deferral is gone, taxed as if you'd simply sold. And to defer the full amount, the replacement property has to be equal or greater in value. Any shortfall, any cash you pull out along the way, is called boot, and boot is taxable the moment it touches your hand. At this scale, you're not doing one exchange. You're running several refinances, several 1031 exchanges, and several new syndications at the same time, on different properties, on overlapping timelines, cycling equity out of stabilized buildings and into new acquisitions before it ever really sits still long enough to count as cashed out. A property that's fully leased and boring, generating steady but unspectacular returns, becomes a source of fresh capital the moment you exchange it into something with more upside, without a tax bill interrupting the transfer. Something else changes quietly here too. The lenders change. Institutional-style credit lines and larger, more favorable financing terms start becoming available, not because any single deal looks different, but because the holding company itself now has a track record, years of debt service paid on time, exchanges executed cleanly, a balance sheet a credit committee can actually read. You stop being underwritten deal by deal and start being underwritten as an institution. That's the real change at this level, and it's less about a single mechanism and more about a change in what you're even measuring. Up through level 5 you were still, in some sense, counting deals, this acquisition, that syndication, this exchange. At level 6 you stop counting deals and start reading the portfolio as one machine, with capital flowing through it the way blood flows through a system, gains recycled instead of extracted, taxes deferred instead of paid, every property just one moving part in something much larger than itself. At this size, an LP writing an $8 million check isn't a solution anymore. It's a distraction. You need capital in units of $30 million, $80 million, $150 million, moving fast enough to keep pace with a pipeline that size, and there are only so many individual investors on Earth who can write checks like that, let alone want to. So the capital source changes one more time. The holding company starts fielding money from institutional allocators in family offices instead of individual LPs. Family offices are worth understanding specifically because they don't behave like a typical fund. On average, they put roughly 18% of their total portfolio into real estate, and plenty run that number up toward 20 to 40%. Real estate isn't a satellite allocation for them, it's core. And increasingly, they don't want to buy into a blind pool fund where someone else picks every deal without them. They want to co-invest directly or back a single operating partner they trust and let that partner run the whole platform, which is exactly the seat the holding company now occupies. Not a fund manager collecting checks from strangers. An operating partner a family office chose specifically because of everything built at levels 3 through 6. And to be trusted with that kind of capital, the company has to start looking like the kind of institution that used to feel impossibly far away. There's an investment committee now, not just your gut and a spreadsheet, formal underwriting standards every deal has to clear before capital moves. Concentration limits capping how much of the portfolio can sit in one market or one asset class. So a single bad submarket can't take the whole platform down with it. The instincts that got you through level 2, moving fast on a good gut feeling about a distressed duplex, would get flagged and rejected by the very committee you built to protect this stage of the company. Here's the image worth sitting with, because it's the one that closes the loop on everything before it. The exact structure you built at level 3, one LLC, holding one small multifamily property, financed with a DSCR loan you barely qualified for, has scaled into the same species of entity, now managing hundreds of millions of dollars. Same organism, same basic idea, an entity that holds real estate and answers to the people who capitalized it. Just more zeros, more people, more committees standing between an idea and a wire transfer. And that's the actual lesson sitting underneath every dollar figure in this video, the thing worth remembering long after you forget the DSCR ratio or the 1031 deadlines. Every level required a different tool, not more of the same tool. The down payment percentage that got you into a duplex would never get you into a $40 million syndication. The gut instinct that made BRRRR work would get you fired from your own investment committee. Scale was never the hard part. Knowing when to put the old tool down was. So here's the mistake, the one hiding in plain sight across every level you just walked through, and it isn't a bad deal or a bad tenant or a bad market. It's loyalty to a tool that already did its job. It's still trying to BRRRR your way to $50 million at level 5, refusing to touch LP money because the last 3 deals you did alone. It's staying the sole decision maker past the point where an investment committee should exist, because handing off control feels like losing the thing you built. It's holding a property forever instead of 1031 exchanging it into something bigger, because the deadline math feels riskier than just not moving at all. Every one of those is the same mistake wearing a different outfit, using the tool that worked at the last level, at the level that needed a new one. That mistake doesn't show up as a loss. It shows up as a plateau 2 years, 5 years, sometimes a decade spent circling the same net worth, working harder every year for the same result, wondering why the ceiling won't move, when the real answer is that the tool changed and you didn't. Knowing which level you're actually on, and which tool that level actually requires, is the entire game. That's not something a video this length can fully hand you, and it shouldn't pretend to. If you want the fuller version of this, the levels, the mechanisms, the mistakes that cost people years instead of dollars, the links in the description to the book that helps explain all this properly.